Back, RJ Horwitz for Foliage Properties. I like to explain the way that we view supply and demand economics as it relates to the real estate and the financial markets. One, the demand for housing and the demographic. The demand for housing actually increased dramatically as interest rates started going down in this country. What was very interesting was the demographic. You had first-time home buyers and you had people that were looking for their vacation homes, which were second-time, third-time, even fourth-time buyers of real estate. And what's happened is that you have a limited pool of people, about 70 million people in this country, that would qualify under traditional terms and conditions. We also had something very interesting was as the interest rates went down, you had the supply of money actually increase. As interest rates go down, people can afford more and more property, or more price of the property, which drove up a demand for that property, which created a feeding frenzy or price wars, as you are well aware of. But at some point you run out of the number of qualified buyers. Number three, you have that saturation of the available home buyers altogether. Once you spend the money, it's not like going to the gasoline station and buying tanks and tanks of gas. You buy one house and then you sit on it for a little while. Number four, Wall Street creates a sub-market. Why? Because they ran out of the qualified buyers. Meanwhile, you had institutions that were going to Wall Street saying, look, we need returns on our investments, our pension funds, our retirement accounts need a rate of return. We're looking for yields in the neighborhood of 10% or greater. Wall Street came up with a thing called the sub-market, the people that would not traditionally actually qualify under Fannie Mae and Freddie Mac. So the problem here is, how do you create a market that didn't exist in a marketplace that is very risky with a high dollar amount? Wall Street had a solution. They are a conduit. They filled the demand for the lack of supply that was available. So the creation of financial products for people who do not qualify under traditional terms and conditions set forth by Fannie Mae, Freddie Mac, which was the bellwether standard. And then, at some point, this stuff starts imploding. Why? Because the people that got those mortgages don't qualify for those mortgages, and there's a specific reason why they didn't qualify for those mortgages. And therefore you have the defaults. You're looking at roughly 25, 27 million people in the country that got those types of loans. These are the subprime. We're talking about the liar loans, the no income, no asset loans, the state income, state assets, the just sign the application and give us an address type of loan. What happens, you have a reset of the markets, an implosion. The problem is that if you have too many loans going bad at a very short period of time, the banks have to take and set aside an amount of money. If it was $1 million loan, they'd have to set aside $2.5 million in cash on top of the million. So they got $3.5 million tied up. Why? Because of the fact that Department of Banking regulators require those reserves. They're called loss reserves in order to qualify to be a solvent bank. Bank of America was going under, people. We cannot have that happen. What happens? Everyone petitions, Chase, Bank of America, you name it, went and they created TARP, which is the bailout of the banks in the tune of $750 billion and growing. What they did was lent the banks the money so they can meet the ratios. So when the Department of Banking came in and looked over their books, do you qualify as a solvent or insolvent bank? They would qualify. That's what went on in this country. It's still going on. There are still tens of millions of people exposed to the loss. What's nice about this is the banks are going to win either way it happens, because they get reimbursed for 80% of the original loan amount. And then they have the insurance on the other side, and then they take promissory notes from the homeowners. So either way, they're winning. What we do at short sales is get them out of the obligation, the property owners out of the obligation. We reverse engineer those mortgages and we make things happen. It's a four-way win for the homeowner, the bank, the realtor, as well as us. Stay tuned.